Hey traders, Gavin McMaster here from Options Trading IQ, and today we're going to be looking at IV crush after earnings. Quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So in today's video, we're going to discuss an important aspect of options trading known as IV crush. So you may have heard this term before. Understanding IV crush is crucial for option traders, especially during earnings seasons, as it can significantly impact option pricing and trading strategies. By the end of this video, you'll have a clear understanding of what IV crush is, why it occurs after earnings, and how you can navigate it effectively in your options trading. Let's get started. So what is IV crush? IV crush refers to the rapid decrease in implied volatility levels following a significant event, such as earnings announcements. IV crush results in a decline in option premiums, particularly for options with near-term expirations. Let's look at some examples. Here we're looking at Netflix, and you can see quite clearly that it has a pattern of implied volatility rising into earnings, and then as soon as earnings is announced, there's a big drop in implied volatility. So that's the IV crush. You can kind of visualize that on the chart here happening every quarter, rising into earnings and then dropping, rising into earnings, dropping, rising into earnings, then dropping, rising into earnings and dropping. So that occurs every quarter and is pretty pronounced on a stock like Netflix. As I said earlier, not all expiration dates are going to be impacted equally, and the biggest impact is on shorter term options. So here we are looking at the money options for Netflix and different expiration dates. Before the earnings date for May, implied volatility was nearly 50%. After earnings, the at the money puts dropped to 33%, so a decline of 16%. You can see June dropped by 9%, July by 6%, September by 4%. So the biggest impact is on the front month, on the shorter term options. Let's go and look at another example. So here we're looking at a cash secured put trade on AMD the day before earnings. And we're using a software that I love called Option Net Explorer. There'll be a link in the description for a cheap trial that you can get for this software. The reason I love it is we've got 5 different T lines here, so we can see how the trade is going to progress over time. It's a fairly short-term trade. We're selling the 152.50 put, which is about a 16 delta. We're using the Feb expiration date, so 17 days to expiration. Now you can see here implied volatility is elevated. It's 61% for this 15 delta put with the short-term expiration. If we go further out in time, you can see the IV is only about 50%, then 45%. So it does drop as we go through time. So even before earnings, when the implied volatility is rising, that's impacting these short-term options as well. Now, what we can do is we can fast forward here one day. This is the day before earnings. This is the time in Australia in case it looks a little strange, but you can see here after earnings, the stock has actually dropped 2.5%, but because it's dropped less than the expected move, the trade's actually profited. So normally you would think if we sell a put option and the stock drops, that's going to be bad for us, right? And generally that is true. But in this case, because of the IV crush, we've actually done well. The IV crush has benefited us more than the stock dropping has hurt us. So you can see here we're around a 14 delta. Our delta's actually dropped and the implied volatility has dropped from 60 down to 44, and the value of the option has dropped in 50% or so. So why does IV crush occur? Firstly, because of market anticipation. Before an earnings announcement, option prices often reflect heightened uncertainty and anticipation of the event, leading to elevated implied volatility. Post-earnings clarity, so once the earnings report is released, the uncertainty diminishes, leading to a decrease in implied volatility as traders adjust their expectations. And depending on whether the earnings report exceeds or falls short of expectations, market reactions can vary, but IV crush tends to occur regardless of the outcome. So it doesn't matter if the stock goes up or down, there's always going to be IV crush. So what are some good strategies for IV crush? The best strategies for IV crush will be anything that is short volatility, provided the stock stays within the expected range. Now, that AMD example we looked at, it did stay within the expected range, but if it had have dropped, say, 10 or 15%, obviously those sold puts wouldn't have done well because the move is outside the expected range. But some short volatility strategies that you might consider for IV crush include the iron condor, short straddle, short strangle, butterfly spread, bear call spread, bull put spread, put ratio spread, and a call ratio spread, and of course just naked puts as well. So in conclusion, an IV crush is when the extrinsic value of an options contract declines sharply because of a significant event occurring, such as the reporting of earnings or a regulatory announcement. It occurs due to the increasing uncertainty in the lead up to a significant event, followed by the sudden and sharp drop in uncertainty as the event occurs and the general market digests the results. Traders can protect themselves by avoiding options with high implied volatility, avoiding options with an event occurring in the expiration month, and avoiding options that have a higher implied volatility compared to historic norms. However, by doing so, they risk missing out on potentially lucrative short-term trades if the realized move is smaller than the market expects. As with any trading approach, ensure you exercise appropriate risk management and trade with a well thought out strategic approach. Thanks for watching and have a great day.